Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Mike, welcome back.
Hello, Ivan, and just thanks for having me back. I've been upgraded. I don't know if I've been downgraded to senior macro strategist.
Oh, nice. No, that's an upgrade.
I don't
That's
know.
a,
We'll see. Better get it right, right?
it's a huge pleasure having you back on
Oh,
Wall
thanks for
Street
having me.
Silver, Mike. Yeah, no problem. I think one of the biggest questions out there right now is, have we made it through the worst of this mini banking crisis, or no, is just this just the beginning? What are you keeping an eye on, Mike?
The latter, just beginning. It's very unlikely, I think, because what caused it hasn't changed. There was this rapid increase in interest rates and duration mismatch, and that hasn't changed. In fact, rates are still going up. So the Fed has raised rates twice since the crisis started this year, the banking crisis. Now it seems to be alleviated, but the credit crisis, I think, is only getting started. Credit crunch. I
Hmm.
mean, you just look at bank deposits leaving, total deposits leaving banks. Probably dropping at the fastest pace ever, around 5%. It's alleviating a little bit, but it's very unlikely to expect that effect to show up in a month or two. It usually takes at least a year, I mean, to really
Hmm.
show up. So the long and variable lags is part of the reason the Fed's probably not going to hike more, and they think more than done enough. But to answer that direct question, very unlikely. Now we've picked we in bottom line is what caused it is still there. In fact, it's more so. Rates, I just look at that, Fed funds upper end is 5.25, and I look at that 30 years 3.9 for a reason. The long end is expecting that deflationary recession.
How bad do you think this deflationary period will be? Will it hit commercial sector? What sectors will it hit?
To answer your last question first, commercial, we always see commercial real estate. It's going to be the worst deflationary period of a lifetime. And I say
Uh,
that I'm 58, and that's my outlook. And that's also based on the simplistic, um, I would say, reciprocal response to the biggest pump in liquidity ever that's dumping at the fastest pace ever. All the rules of cycles, booms and busts, are in the back of this happening.
and Mike, we're seeing like in the Wall Street silver community and in the gold community as well. We've been waiting for over a year. Basically, a lot of people in our camp are trying to say the second the Fed pauses or actually pivots and starts lowering rates, that's when you'll see precious metals like gold and silver start really making some movement higher. Is that like you're saying you don't think the Fed will do even a rate hike and they should have paused before? Are you in the same camp that precious metals will have that catalyst the second the Fed actually pivots?
Well, I think gold will. I mean, there's a
Right.
big difference, I think, between silver, which is more than 50% industrial now. And comparing that to the past doesn't make sense anymore. Now, obviously, it has a 1.6 beta to gold historically when the Fed's easing. But it also silver can typically outperform like copper.
Right.
Can typically outperform gold in an expanding global economic demand pool environment that's demanding these industrial metals. And it's
Right.
all tilting the opposite. We see what Europe is tilting towards recession. China is really starting to disappoint in data. It was fully expected. And so what I see is a much likely environment. Gold's going to outperform virtually all assets with long bonds in an elongated potentially depression. Now, if I'm
Right.
wrong, that would be wonderful. But that's where I think silver's stuck in the middle. So I think it's wonderful. It's great that silver is up almost 14% on a 1 year basis, double that of gold. But at $24 an ounce, I'm fully fearful that what's going to happen is gold's going to break out, and what's knocking on that two handle is going to go to three eventually,
Hmm.
three handle 3,000, and silver is going to stay stuck because the Fed to pivot has a number of things. This is what's changed from the past, as our chief economist Anna Wong pointed out, is their models show the Fed should start easing very soon, but all these sticky inflation metrics show they won't, they can't. And I view from all the things we've heard from Chairman Powell, they're going to take this advantage, this opportunity to cut that umbilical cord where all the market cares about is the Fed providing that that liquidity every time risk assets go down. So I think they're seizing that moment, and that's why they're still jawboning and why futures are
Right.
still showing that tightening. So the key thing I watch is Fed fund futures in 1 year stuck right around almost 5%, 4.7% at the moment. 4.4% in the moment. Still relatively high. I mean, obviously starting to price freeze, but not a significant amount. The key question is what's going to take for that? And I think that's where a risk asset decline is what I'm really worried about. Now, crypto's already indicating that. Bond yields are already indicating that. Commodities are indicating that, but to me, it's all going to be predicated on the stock market. So what I'm really expecting is that gold to S&P ratio to break out higher. That's what I published on today. And
Interesting.
it bottomed in around 2000, but and if you look at gold versus the S&P going back 100 years, it's been a stable value. But right now,
Right.
gold is about half the index value of the S&P 500. I think it's just going to go back to one.
Really?
So
Yeah,
what is it?
that'd be
Maybe.
incredible.
Well, like it's incredible if you look back in the past, but if you really analyze what's happening, I think we're going, say, gold getting to 3,000, S&P 500 getting to 3,000 is not a big deal in a typical recession. How about this? On the back of the biggest liquidity pump in history,
Right.
and then the biggest liquidity dump in history. So to get a typical recession out of that is seriously silly. You should expect a recession reciprocal of what's happened. And that's key point I like to make is we're seeing this banking crisis and plunging commodities and something that's never happened. The Fed has never tightened in this environment, and they already have twice this year, and they still have that trigger finger. So Fed fund futures say if they don't, they're not going to tighten at this meeting, which I fully expect they won't. But they're up to almost 60% that they'll go 25 at the July meeting. But
Right.
by the time we get to July 26th, I fully expect we'll be in the signs of the recession will follow what commodities are already warning us.
And what do you expect to happen to banks? Will we see more regional banks start to go under, or like because we've seen like three or four go under, and the amount of money was someone said it was more than all of the 100 banks that collapsed in 2008. These regional banks. So what do you see happening with regional banks, Mike? How scary is that outlook in 2024? Let's say if they keep
Not
if the Fed have no control over anything.
not to be a scaremonger, let's look at the facts. What has changed to stop that trajectory of regional banks and deposit outflows from most banks toward higher yielding money markets and the 2-year note
Hmm.
at 4.6%? What has stopped that trajectory? Nothing. It's accelerating.
Right.
So to expect that little banking warning we got back in March to be completely alleviated, as we haven't even started this contraction in economic activity, which has been highly broadcast by the yield curve, is just, to me, silly. I think
Yeah.
it's just getting started. Here's what I think is going to happen. We should not see any significant signs of an end to this until we have a long and variable lag to a significant period of Federal Reserve easing liquidity. That's not a profound statement. That's the way things have always worked in history. So I'll end with one thing that we had our morning strategy session this morning, and my
Yes.
FX colleagues, Audrey Fitchell Freeman, made a simple statement that struck me is we had a surprise rate hike from the Bank of Canada last week.
Yeah.
Until we see a series of surprise rate cuts, it's very unusual to expect a bottom in what I think is a recessionary bear market, deflationary bear market that's just getting started. Now, that's clearly the case in commodities. It's a severe recessionary deflation market. It's
Hmm.
clearly the case in the inverted curve showing recession and deflation. It's definitely happening in cryptos. This last quarter, Bitcoin and cryptos plunging and the stock market going up. There's
Hmm.
still that one missing link. So I look at it as just the fact that we're still asking this question. We have to answer it by saying, well, there's been nothing done except one-offs. And each the treasuries help certain banks, Department of Treasuries and U.S. government departments helping banks that have had problems. But the macro is actually worse. Rates are higher, and asset values, with the exception of the stock market, are just starting to tick down. We look at things like housing,
Yeah.
commercial real estate, just getting started.
Well, we're it's a very scary time. Like from now, I think till 2024, 2025. I honestly think what you're saying is spot on. So it's a huge pleasure having you come down to Wall Street Silver, Mike. It always is. And hopefully, as the market develops in the next 2, 3 months, and we see what Powell and the Federal Reserve does next and the market, we'd love to have you back on. It's always great.
Well, I'm looking forward to it. Last thing I'm out to do is scare people. I look at it as one of the simplistic environments I've ever seen. That U.S. government, who you note at 4.6% is basically guaranteed 9% in 2 years,
Yeah.
and you can relax and say worst case you miss out,
Yeah.
and that means everything else is fine. Jobs are plenty, and you're fine. So to me, it's simplistically is that there's certain times you're supposed to not try to overcomplicate things by trying to pick sectors and which value stocks or which area. I mean, AI kind of related equities. Just
Absolutely.
say thank you, U.S. government. And that put the fact that here's one thing I'll end with. This week, we're expected CPI year over year is going to drop to 4.1%. That's a collapsing trajectory. It's dropping at the fastest pace since the financial crisis. At the
Right.
same time, we're going to see if Fed funds and the upper bound is at 5.25%. That's above CPI and still moving higher. See that? It's bodies in motion. What's going to take that to stop?
Yeah, yeah, no, I totally agree. Well, Mike, a huge, huge pleasure having you on Wall Street Silver. And yeah, seriously, we would love to have you back in the next 2, 3 months.
Looking forward to it, Ivan. Thanks for having me.
Talk to you soon.